Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Parmar.
Welcome to Wealth Matters podcast. And this is Monday's section where I talk about my experiences, experiments, the investments I'm working on, assets I'm investing in, etc. I talk about that. Last episode, I spoke about analyzing real estate investment for 10 minutes. Today, I want to take another 10 minutes and speak about depreciation in real estate. This has been a big topic, and every time I talk to my friends or investors, they always want to find out what do I mean by depreciation, how does it work, and why not many people know about it. All the real estate investors pretty much know about depreciation or a paper loss because someone else is using your property, and the property, when it's being used by someone else, it depreciates. So that's a pretty important thing to remember. And this is why Trumps or Mitt Romneys of the world, they love real estate. Why they don't pay tax? Because they have a lot of depreciation losses. So this is very important, and I'll try to, if you're watching this on YouTube, at some point, I'll share my screen as well and show you one of the real, true K1 I have received a partnership return from one of the syndication investment I made, which shows how depreciation works. So what is depreciation? Depreciation is basically an accounting method of allocating the cost of a tangible asset over its useful life. And it is used to account for declines in value, right? So the most common form of depreciation is straight line depreciation, which allows the deduction of equal amounts each year. The annual deduction is the cost of the item divided by its useful life. And the IRS considers the useful life of residential real estate to be 27.5 years. So the annual depreciation on a rental property, which is a residential property, which is worth about $1 million, excluding the land value, would be million divided by 27.5 years, which would come out to around $36,363 per year. Remember, it's excluding land value. So let's say you have $1.5 million property, and 500,000 you allocate to land, and the rest, $1 million, is allocated to the building and structure and everything inside. So that's how, and then you divide that over 27.5 years for a residential building. So it would be single family house to a small office building, could be as well, any type of real estate, duplex, fourplex. But when you go up, when you start buying large properties, the things change. And that is why syndication or buying a large property even makes so much sense. And that's, and a lot of time depreciation is overlooked, or your CPA would only look at straight line depreciation, right? And commercial property or a warehouse or apartment building to mobile home park to self-storage, you can depreciate the same thing over 39 years. So now you would be thinking how going bigger is better, because I can write off it for $1 million over 27.5 years and I get around $36,000 to write off. Then that is better than writing off $1 million over 39 years, because now your deduction each year would be smaller. But there is a magic in it. It's called bonus depreciation or cost segregation. And that's what I want to talk about, because now that if you have understood what straight line depreciation is, which applies to most of your residential real estate and not to commercial real estate. Commercial real estate, there is something called bonus or accelerated depreciation using cost segregation. It's a great strategy. Basically, cost segregation is a strategic tax planning tool that allows companies and individuals who have constructed, purchased, expanded, remodeled any kind of real estate to increase cash flow by accelerating depreciation deductions and deferring income taxes. Cost segregation study has to be performed by a cost segregation engineering firm, so there is a cost to it, but that firm will dissect the construction cost or purchase price of the property that would otherwise be depreciated over 27.5 years or 39 years. The primary goal of a cost segregation study is to identify all property related costs that can be depreciated over 5, 7, and maybe 15 years. So now you are reducing the depreciation timeline from 27.5 years or 39 years to maybe 5 years, 7 years, 15 years, etc. As a result of that, we can see significant deductions which can result in a sizable paper loss in the early years of owning the asset, right? Because 5 years, 7 years, etc. And you would think, what would I be able to write off? Oh, let's take an example of an apartment building or a senior housing facility. You could have light switches, tons of light switches in each of this apartment building, right? You could have tons of fans, appliances, dishwasher to refrigerator to stove. There are lots of things. Basically, it would be mostly anything other than the structure, right? So everything which can break apart in 5, 7 years, 15 years, etc. So that's why if you buy a single family house or a duplex or fourplex, this wouldn't apply. But when you go bigger, let's say you have 40, 50 units or 100 units, this makes so much sense, right? So now let's talk about bonus depreciation. One of the major changes with the TCJA, Tax Cuts and Jobs Act of 2017, was the bonus depreciation provision, where businesses can take 100% bonus depreciation on a qualified property purchased after September of 2017. On top of that, accelerated depreciation is any depreciation you can take during the early years of the life of an asset. So before, if I could take certain depreciation over 5 years, now I can even take the entire thing in the first year itself as 100% bonus depreciation. So it's getting better and better. And depreciation basically acts as a phantom deduction because you get the deduction, but you haven't lost any of that money, right? So let's now take another example that you invested in your own apartment building, mobile home park, senior housing, or maybe you invested in a syndication, right? You make $10,000 for the first year, but you see a depreciation of 40,000, 50,000. Now your K1, your tax return will show negative. Let's say it was 50,000 negative and you got $10,000 in your pocket. Basically, your K1 will show negative 40,000. So even though you got 10 grand in your pocket, you have a paper loss of 40,000. What that means is that you can apply that loss against any passive income. Remember, earned income or the things you do actively is earned. It's called active income or earned income. And what's this passive income? There are two different things. Earned income is subject to marginal tax rate under whichever bracket one qualifies, right? Passive income comes through your real estate investments or syndication investment, and basically any passive loss you see like this can only go against that passive income. So now you would be thinking, oh, I have minus 40,000, but I cannot deduct my W2 income or active income. What should I do with that? Basically, you can carry that paper loss forward till you dispose of that particular asset. Maybe it was mobile home park, it was senior housing, or it was something else, right? Once you sell that asset, then you basically have to go through something called depreciation recapture as well. So and pays back some of the deductions you have taken, right? So let's say you took all this deduction for 5 years, you sold this asset, then you have to account for all the depreciation you took, right? But that rate is still maxed at 25%, so much better than the top income tax bracket. And not only that, but you deferred paying taxes for so many years, you were able to take that money and reinvest. So it's basically compounding your money. Let's say you make $10,000 every year for 5 years, and you are carrying forward that $50,000 loss for those 5 years. So basically, you paid zero tax on that 10,000 for 5 years. So 10,000 multiplied by 5 is 50,000, right? You paid zero tax on that amount, and you reinvested it somewhere. That money continued to grow while you deferred taxes, and that end of year 5, you decided to sell the property. Now you have depreciation recapture, you have to pay tax on it, but the money grew, the money compounded, and you were able to basically reinvest that money. And also, to take it further, you can literally buy another property that same year. You are going to sell this asset and go through this same cycle again, do a bonus depreciation, cost segregation, or invest in a syndication where they will give you huge depreciation. So this is why I continue to do it. As and when I'm selling an asset, I make sure I invest in another asset from where I can get depreciation loss. So it's a pretty great way to continue to defer your taxes legally. Nothing major needed other than making sure that you have all the documentation regarding cost segregation if you own that asset yourself. If you own that asset through a syndication, the partner or the operator will take care of that. So the next thing I want to show you how one of the tax return or the depreciation I have a K1, and how the depreciation looks on that K1, right? So let's look at it. This is my Schedule K1 Form 1065 from 2019. What this means is that I am a partner in the LLC. So when you own the real estate yourself, maybe you own it on your own name, or maybe you own it through LLC, right? So, but that could be a single member LLC, so there is no partner. But when you invest in a real estate through a syndication, then you are a partner in the LLC, which owns that apartment building or mobile home park, etc. Right? You are a partner, and you have percentage share of that particular LLC, which owns the real estate. So this was from my very first year of the investment, right? And as you can tell, I invested 50,000, and because we did cost segregation that year, it shows negative 33,000 which is a paper loss, right? So this is my ending capital account. This is what show. Again, this is a paper loss. I haven't lost any money, but this is because of the cost segregation we did. So when I'm filing my taxes, my CPA takes this amount minus 33,000 and puts it on my tax return. And what that does is any passive income I have had from all the real estate, from all my investments, passive income, they will all get applied against this 33,000 of paper loss. So now, even though I got that passive income in my pocket, that 33,000 will nullify all those income. And what that will do is, of course, reduce my taxes, right? Because I don't have to pay tax on that passive income. So this is huge, and this is what I wanted to talk about. So please keep watching Wealth Matters podcast. Let me know what you think is of this depreciation benefits, and please subscribe to my channel on YouTube as well as Apple Podcasts, and please leave 5-star rating as well as share with your friends. Sharing is caring. Thank you so much again for watching.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!